Imagine setting sail across vast, unpredictable waters, where hidden risks and sudden storms threaten your journey to financial success. Investing is much like navigating these treacherous seas. While the promise of reaching new horizons is thrilling, the path is fraught with risks. But with the right tools and strategies, you can master the art of managing these risks, ensuring that your investments stay on course. Today, we'll explore essential investment risks and discuss powerful strategies to manage them, helping you transform uncertainty into opportunity. Investment risk is an inherent part of every financial journey. Recognizing and understanding these risks allows investors to anticipate potential challenges and prepare accordingly. There are several primary risks in investing, each carrying unique impacts on a portfolio. Market risk. Market risk is the possibility that the value of your investments will decline due to broader economic forces, geopolitical events, or changes in investor sentiment. Imagine the stock market as a vast ocean, its waves and tides influenced by everything from inflation and interest rates to political events. Because these forces are often beyond an investor's control, market risk can affect almost any asset. Understanding economic indicators and maintaining a long-term perspective can help investors navigate the shifts in market sentiment and avoid reactive, short-term decisions. Credit risk. Especially relevant for bond investors, credit risk arises from the chance that a bond issuer may default on their obligations. It's like lending to a merchant who may or may not repay the loan. To gauge credit risk, investors often examine credit ratings and financial health indicators, just as a ship captain would assess the reliability of their crew before setting sail. High-yield bonds offer higher returns but come with increased risk, while investment-grade bonds offer stability with lower returns. Liquidity risk. Liquidity risk reflects how easily an investment can be converted to cash without affecting its price. Some assets, like stocks, are highly liquid and can be sold quickly in active markets, while others, such as real estate or certain collectibles, may be more challenging to sell in a timely manner. Liquidity risk is like finding yourself on a deserted island when you need access to cash. When choosing investments, consider how accessible your money needs to be and plan accordingly. Concentration risk. Concentration risk comes from placing too many assets in one type of investment, sector, or geography. It's like storing all your valuables in one compartment of a ship. If that compartment floods, everything is at risk. Diversification across different asset classes and markets helps reduce concentration risk, ensuring that a downturn in one area doesn't drastically impact your entire portfolio. Inflation risk. Inflation risk is the erosion of purchasing power over time, much like a coastline receding as the sea steadily rises. If investments do not outpace inflation, they effectively lose value, as each dollar buys less over time. To counter inflation risk, investors often choose assets that historically beat inflation, such as equities or real estate. Behavioral risk. Behavioral risk is the result of emotional and psychological biases that can influence decision-making. For instance, panic selling in a downturn or overconfidence in a rising market can derail a sound strategy. Behavioral risk is like an internal storm that clouds judgment, leading to impulsive actions that may be contrary to long-term goals. Recognizing these biases and developing a disciplined investment approach can mitigate behavioral risk. Managing risk is not about avoiding it altogether, but learning to navigate through it with strategies that align with your goals and risk tolerance. Let's explore some key risk management techniques. Diversification. Diversification is the cornerstone of risk management. By spreading investments across various asset classes, sectors, and geographies, you reduce the impact of a downturn in any one area. Imagine a fleet of ships carrying different cargoes to various ports. Even if one encounters rough waters, the others continue, safeguarding the overall voyage's success. Diversification helps smooth returns and enhances stability, making it one of the most powerful tools in managing risk. Asset allocation. Asset allocation is the art of distributing investments among different asset types, such as stocks, bonds, and cash, based on an investor's goals, time horizon, and risk tolerance. Think of it as choosing the right vessel for different journeys. Bonds provide stability, stocks offer growth, and cash offers liquidity. A balanced asset allocation is essential for aligning the portfolio with an investor's unique financial objectives and ensuring that each asset class serves a purpose in reaching those goals. Stop-loss orders. Stop-loss orders are automatic sell orders placed on an asset once it falls to a predetermined price. This technique acts like a safety net, ensuring that losses are contained before they spiral out of control. While stop-loss orders don't prevent all losses, they do limit exposure, preserving capital for future opportunities. Rebalancing. Over time, market fluctuations can cause a portfolio to drift from its original allocation, increasing exposure to certain risks. Rebalancing involves periodically adjusting the portfolio back to its intended asset allocation, much like a sailor adjusting their course to stay on track. By rebalancing, investors maintain their desired risk level, aligning the portfolio with their long-term goals. Long-term perspective. Maintaining a long-term perspective is one of the most effective ways to mitigate market volatility. Markets experience ups and downs, but over extended periods, they tend to rise. Embracing a long-term outlook allows investors to ride out short-term fluctuations and benefit from compounding returns. It's like staying calm in a storm, trusting that the waves will eventually settle and the journey will continue. Alternative investments. Adding alternative assets like real estate, commodities, or hedge funds to a portfolio can enhance diversification, as these assets often behave independently of stocks and bonds. For example, gold tends to rise during periods of uncertainty, providing a hedge against traditional market risks. By including alternatives, investors build a portfolio with greater resilience to different economic conditions. Behavioral finance studies how cognitive biases and emotional factors influence financial decisions. Recognizing these biases is crucial for investors, as they can lead to costly mistakes. Overconfidence and confirmation bias. Overconfidence can lead investors to take excessive risks, believing they have better insights than the market. Confirmation bias, on the other hand, causes investors to seek information that supports their existing beliefs while ignoring contrary evidence. Both biases can distort decision-making. Developing a habit of questioning assumptions and seeking diverse perspectives helps mitigate these biases. Fear and greed. These powerful emotions can drive irrational behavior, leading to market cycles of booms and busts. Fear may trigger panic selling, while greed may lead to speculative bubbles. Understanding these emotions and maintaining a disciplined approach to investing helps prevent rash decisions and keeps investors focused on their goals. Herd behavior. Herd behavior occurs when investors follow the crowd, often resulting in bubbles or crashes. This behavior shows the collective impact of individual decisions, each influenced by psychological factors. A disciplined investment plan and regular review of financial goals help investors stay grounded, avoiding the pitfalls of herd mentality. Stress testing involves simulating how a portfolio would perform under extreme conditions, such as a market crash or rapid inflation. Think of it as testing a ship's seaworthiness before embarking on a journey. By applying hypothetical scenarios to your portfolio, you can identify potential weaknesses and prepare accordingly. Stress testing helps investors understand which parts of their portfolio are vulnerable and make adjustments to increase resilience. For example, in a market downturn scenario, stocks may lose value rapidly, but bonds or alternative assets like real estate may hold steady, providing stability. Knowing how your assets respond in different conditions enables you to make informed adjustments, reinforcing your portfolio's structure to withstand unexpected events. Insurance products serve as an essential layer of protection, transferring specific financial risks to an insurer. Think of insurance as the reinforced hull of your financial ship, shielding you from unforeseen events. Life insurance. Life insurance provides financial support to your loved ones in the event of your passing, helping them cover expenses like mortgages, education, and daily living costs. Health insurance. Health insurance guards against the high costs of medical care, ensuring that illness or injury does not lead to financial ruin. Disability insurance. Disability insurance provides income if you are unable to work due to illness or injury, ensuring continued financial stability. Insurance products are indispensable for managing risks that lie beyond the scope of investments alone. They provide a financial safety net, ensuring that unexpected life events do not derail your journey toward financial goals. Navigating the world of investing is a journey filled with both opportunities and risks. While risk cannot be eliminated, understanding its many forms allows investors to make informed choices, preparing for storms before they hit. By diversifying, allocating assets wisely, rebalancing regularly, and maintaining a long-term view, you can build a portfolio that weathers market volatility with resilience. Adding insurance and alternative investments further strengthens your financial position, ensuring that your ship remains steady even through turbulent waters. Behavioral finance offers insights into the psychological challenges of investing, encouraging a disciplined approach that mitigates emotional impulses. And by stress testing your portfolio, you anticipate potential hazards, strengthening your investment vessel to withstand unforeseen events. In the vast ocean of financial opportunity, managing risk is the compass that keeps you on course. With a steady hand, clear goals, and a robust strategy, you can navigate these waters confidently, transforming risk into a controlled force that propels you toward your financial dreams.